Hey everyone, this is Gene Goldman. I'm the Chief Investment Officer for Cetera Financial. Welcome to my presentation, Market Update. Equities may need a breather. So what I'll do today is talk about our three themes for the rest of this year. And I know we shared these with you last time, but I'll talk about those themes. But more importantly, I want to talk about the markets lately, because the markets lately have been a little bit, let's just say, gotten a little ahead of themselves, maybe a little frothy, maybe a little bit too optimistic. So what I'll do is talk about our three themes, but more importantly, weave in why, there's lots of great news in the economy and inflation, but maybe the markets are a little too optimistic. So maybe we might have a pullback. If we do have a pullback, though, the good news is that we do expect it to be very short-lived. So let me dive right in. So as a reminder, we talked about this a couple times already, but our three themes for the rest of this year is as follows. Number one, the Fed goes from being a foe to a friend. What this means is that the Fed, in essence, goes from raising rates as they did through July of last year to cutting rates this year. I know there's some talk lately that maybe the Fed won't cut rates this year. We don't believe that, and I'll talk about why is that the case. Second theme is that the economy cools into a soft landing. What that means is that we don't see a recession this year. And more importantly, we don't see a recession for the next 12 months. But most importantly is that even if we do have a recession, let's say I'm wrong and a recession comes, we think the recession will be so mild that you may not even feel it. So we'll talk about that too. And third of all, market volatility is going to surge. Right now, the markets have had a huge run. They've run up about 28% or so since the October 27th correction of last year. It's a huge run. It's a huge surge in the market. But because of this surge, this increases risks, and there are more risks out there. We do think this could lead to a pullback. But the good news is that even if we have a pullback in the market, it should be pretty short-lived because there's some really good foundational information about the markets. So those are our three themes. So let's kind of talk about today and in terms of where we're seeing things today. So right now, we foresee the economy and inflation being a sort of like Goldilocks. And a Goldilocks scenario, I remember when we were kids, we all read, Goldilocks and the Three Bears. If you think about what happened, Goldilocks goes and she goes into a cabin and she finds some porridge that's either too hot or too cold. She finds a bed too hard, too soft. And she finds a bed that's just right, porridge that's just right. We think the economy is just right now. And same thing with inflation. So let me talk about why. So you look at this chart, and I know I've shared this chart with you maybe a few quarters ago, but this chart shows the City Economic Surprise Index. So what this is basically this. If a data point comes in above expectations, the line moves higher. If the data point comes in below expectations, the line moves lower. Look on the far right-hand side where I have that red arrow. The data is coming better and better and better. Good news, the economy is getting better. What we're seeing is that basically areas that are in recession today, and let's face it, there are some areas in recession, like housing and manufacturing, they're starting to improve. They're starting to get a little bit better. If you look at this next slide, and this next slide shows two data points. And as a side note, for my slides, I organize them in pretty much the same way. The horizontal axis is time, and the vertical axis, I'm plotting a data point. So in this case, we're plotting two data points. The light blue line is building permits, and the darker line is manufacturing new orders. So these are two very forward-looking indicators for housing and for manufacturing. So we know housing has been in recession. Housing prices have come down because mortgage rates have moved higher. We also know manufacturing has been in recession for 15 straight months because after COVID, during COVID, we bought tons of goods. We all bought refrigerators and TVs and washing machines, all those goods. But after COVID, people stopped buying this stuff. So manufacturing definitely weakened. But you look at these two lines, building permits and manufacturing new orders, very forward-looking. Both of those are picking up pretty fast, pretty quickly. So the key point here is that the area in recession today is starting to get better. That's great news. The area that's not in a recession is the consumer. You and I as a consumer, we're spending money like crazy. You see people, going flying, traveling, hotel rooms, airfares. People are traveling like crazy. You and I are traveling. But the consumer, as a consumer, the consumer really, we're not in recession right now. What does worry us, though, is that the consumer, you and I, will be impacted because you have student loan repayments have already started. You have high interest rates. You have credit card debt. Think about this. Right now, there's $1.4 trillion of credit card debt in the United States. That's the highest it's ever been. And some people are paying interest rates of 32, 33%. Very high rates. So you take that, you take the fact that interest rates are higher, you take the fact that maybe the job market is slowing down a bit, the consumer will be impacted. But here's the good news. The consumer, while it does weaken a bit, while we weaken a little bit, we're coming off of a very strong base. How do we know? You look at this slide. This slide shows how strong the employment picture is. So if you look in general, right now, the unemployment rate has been below 4% for 26 straight months, something we haven't seen since the 60s. On average, weekly jobless claims are coming in around 210, 215,000. Those are all great ways to look at the labor market. But more importantly, let's look at this chart. This chart says it very simply that how many jobs are out there, so that's in the numerator, divided by how many people are looking for jobs. So jobs divided by people looking for jobs. Today, the ratio is about 1.38. There are so many jobs out there. So therefore, anyone that wants a job can find a job. That's a good news. That's a good foundational support for the consumer. Again, strong labor market. The other perspective we are focused on is the fact that, again, if the consumer weakens, another data point we can look at that's a positive point is that there's less debt to income out there. You look at this chart. This chart takes debt divided by income. And despite the Fed raising rates over the last, say, 2+ years from 0 to 5 3/8, debt to income has stayed flat around 10%. Consumers have low debt. That's great news. Obviously, debt will start to increase with credit card debt, but right now, debt to income is at very low levels. And why, as a side note, why is debt such at a low level right now? Because even with the Fed raising rates and pushing mortgage rates higher, if you look at this chart shows an interesting story. The light blue line is basically the average mortgage rate, the current mortgage rate right now. And right now it's about 6.8%. It's around 7%. You see the light blue line. But the effective rate on outstanding mortgage debt is only 3.8%, because 90% of mortgages today are either fixed at 15-year or fixed at 30-year. So very low impact on the Fed raising rates in terms of mortgages. New homes, different story, because you have to take a mortgage rate to get mortgage out to buy a new home. But existing mortgages, rates are not moving higher because, again, most of us are locked into these lower rates. So overall, the economy looks great. The economy is just right. It's not super strong. It's not super weak. It's just muddling along. Very Goldilocks. What about inflation? And inflation is so important because, again, remember the Fed. We talk about the Fed many times. The Fed has a dual mandate, and the Fed is the Federal Reserve. Two things. Number one, they want to make sure that we all have jobs. And number two, they want to make sure that inflation is kept in check. So if there's too few jobs, what they do is they lower the primary interest rate, their Fed funds rate. They lower it down. This, in theory, stimulates the economy because borrowing money is cheaper, and therefore companies can go out and do, projects and do these other things. On the other hand, if there's too much inflation, as we've seen over the last few years, the Fed raises interest rates to slow the economy down. Therefore, borrowing costs increase, mortgage rates go higher, and this, in theory, reduces inflation. The Fed has done a good job. You look at this chart. This is the Fed's preferred measure of inflation. As a side note, there are so many measures of inflation. You got CPI, PPI. There's many ways to look at this. The Fed loves core PCE. And there's many reasons why, but basically it's a more diversified basket of inflation at the end of the day. But core PCE, as you see here, and I have the arrow, it's rolled over from about 7% or so year over year down to about the low threes, the high twos. Inflation is slowing down. That's great news. And the Fed is getting the inflation story right. They're slowing down inflation as they're expected to do. That's great news. But the question that's come up lately is, well, if the Fed is slowing down inflation, yes, they should cut rates, but maybe they won't cut rates this year. Maybe the Fed will keep rates steady for this year. And we don't believe that, and I'll talk about why in a second, but there's two reasons why the markets are starting to say maybe the Fed won't cut rates. The first reason is this slide right here. So this is inflation broken out to two components: services inflation and goods inflation. Services inflation is that light blue line, and goods inflation is the dark line. Goods inflation year over year is down, it's negative. So there's really no inflation on goods. So, not TVs, say cars and refrigerators and stuff, it's flat, it's a negative. Services inflation, it's around 4%. That is really troublesome to the Fed because it's hard to bring that inflation down. It's very stubborn, it's very high. So what the Fed is doing is they're keeping rates higher to put pressure on the labor market because basically labor is the biggest component of services inflation. So the concern, again, the Fed may not cut rates this year, which we think they will, is because services inflation is high. Why do we think they'll still cut rates regardless of services inflation? Because the services economy has been slowing down month by month since November of 2021, slowly. It surged coming out of COVID. Now it's been slowly coming down. So we do think this will slowly pressure the services economy and reduce services inflation. Another reason why there's been talk out there lately that, hey, the Fed won't cut rates is because in January and February and a little bit of March, we saw some inflation reports that came in above expectations. Case in point, there's a inflation indicator called the Consumer Price Index, and this is the inflation that you and I mainly see. We talk about in the press all the time. The CPI, Consumer Price Index. In January, when the report came out in February, the market expected it to be at 2.9%. It came in at 3.1%. This surprised the market because it came in well above expectations. Our opinion, that data point was a very bad data point because if you decompose, and we go to this next slide, if you decompose what caused that spread, that positive surprise in inflation, it was one single component, something called owner's equivalent rent. And we think it was a bad data point, maybe an aberration. Because if you look at this chart shows owner's equivalent rent in the dark, and then the light blue line is rent of primary residence. They're slightly different measures of shelter inflation, but they're similar. You look month by month by month, they are very similar. But then see the red arrow in January? Owner's equivalent rent just surged. We think that was a very bad data point or an aberration because then, first of all, if you look to the arrow to the far right, you see it's coming down again and it's much closer to where it should be. So we think that's a very bad data point. Also, we truly believe that this owner's equivalent rent, this shelter inflation is rolling over fast. And you can see it right here. You look at this chart. In this chart, focus on the light blue line. The light blue line is shelter expenses, shelter inflation in CPI. It's high. It's still above where it was. If you look at the light blue line going back to, like, say, 2016 or 2017, it's around 3% year over year. But today, on the right-hand side, it's come down. It's much higher. It's like around 5 or 6% now. It's still pretty high, but we do think it's coming down. Why do we think it's coming down? You look at this slide here. This is a forward-looking indicator for rent. So if you think about CPI shelter, what I just showed you, over the last 12 months, it's been up about 5.8%. But it's a backward-looking data. It's what people have been paying for rent already. Instead, look at this. This is asking rent. This is basically going to like apartments.com, going to Redfin and saying, new properties being listed, where are they being listed from a rent standpoint? And asking rent is down about 1% over the last 12 months. So again, shelter inflation up about 5.8%. It's very backward looking. Forward looking is asking rent is down about 1%. So we truly believe that at the end of the day, this is going to flow into CPI and inflation and slowly further reduce inflation. So a lot of people out there are saying, okay, maybe the Fed's not going to cut rates this year. We still think they'll cut rates. And even the probabilities show this. If you look at this chart, all this shows it. This shows the probability of the Fed cutting rates this year at each meeting. So let me give you an example. You look at in the middle, September of 2024, there's a 69% chance the Fed cuts rates at that meeting. So we do believe that these numbers will improve. There'll be a higher probability of the Fed cutting rates because, again, inflation is rolling over. Yes, it's been a little bumpy lately, but once you start moving in rent and shelter inflation, this should start to come down lower. Plus, the other point is that it takes about 12 to 15 months for a rate hike to be fully felt by the economy. Again, it takes 12 to 15 months for a Fed rate hike to be felt by the economy. Since the Fed stopped raising rates in July of last year, we still have a lot of rate cut hikes to be felt by the economy, which could impact the economy like commercial real estate or banks, et cetera. So again, long story short, number one, The market is very optimistic. The economy looks great. Inflation is slowing down. We do think the Fed will cut rates this year, but there's maybe too much optimism. And why do I say that? And that's my second part. We think there's a lot of optimism in the market right now, maybe too much optimism. And investors today are saying, wow, things look great. The economy looks great. Inflation is rolling over. The Fed should cut rates. And if you see this in market performance, you look at this slide. This slide shows the S&P 500. And see the red arrow? The S&P 500 since the correction low of October 27th of last year, the stock market's up about 28%. That's a big surge in about 6 months. Just use some simple math. For an entire year, that's a gain of like 56%. The market has surged dramatically. Because of this dramatic surge, this has definitely increased risks. Risks have increased because now you have higher valuations, you have concerns about frothiness, you've got all these concerns, which I'll talk about in a second. You look here, the thing is that everyone's extremely bullish right now. Everyone is really optimistic about the stock market. What this slide shows, it's a sentiment indicator. It basically says, okay, how many people are bullish that think that the markets are going to be amazing? How many people are bearish? And it subtracts the bearish people from the bullish people. And the net is that what's in the circle right there. You see, it is extremely bullish. Everyone is so optimistic. Everyone is bullish about the stock market right now, despite the fact that risks are increasing. So what are some of the risks? And here are the key risks that we focus on right now. Number one is that the Fed waits too long to cut rates. Maybe we do get a recession. Number two is that the Fed cuts rates too soon and inflation reemerges. Geopolitical risks are another. You've got the Houthi rebels, you have the war in the Middle East, you have the Russia-Ukraine war, lots of other things that could drag on the economy. It could drag on market volatility. And the last one I really want to focus on, valuations. So valuations are pretty frothy, high, expensive. Let me show you. If you look at this chart shows the PE ratio of the S&P 500. So PE ratio stands for price to earnings. So what this is a valuation measure. The higher the PE ratio, the more expensive stocks are, the lower the cheaper stocks are. So you look in this chart on the right-hand side, the PE ratio of the S&P 500 is over 21. It's high. It's above the average. And the average is that light blue line around 18 or so. It's high. It's pricey. We can justify high valuations when we have low interest rates and low inflation, but we have neither of those right now. What this says to us is that the market is pricing in absolute perfection. Everything needs to be exactly perfect. No hiccups, no mistakes, nothing. The Fed has to cut rates. Everything needs to be perfect. This is what concerns us because those are risks, which I showed you before are happening, and there's other risks. There's concerns about if the Fed will cut rates. You look at this. This is something I pulled, just comments from the newest Fed voting members, and these are the people that dictate should we raise rates or lower interest rates. You look at some of the comments here, and I'll leave this up for a few seconds, but you look at like Thomas Barkin, his comment, real risk that there will be continued inflation pressure. This is something suggesting the Fed may not cut rates as the markets anticipate. This is an additional risk to the market. And again, you have high valuations and risks increasing. This puts pressure on the stock market. Another reason, you look at yields, bond yields, so interest rates and yield. This is the 2-year Treasury yield. And you see the yields have surged dramatically. This is important because as yields move higher, borrowing costs move higher. It becomes more expensive to do projects. This puts pressure on the economy. That's another risk. Another risk is high oil prices. You look here because of the issues in the Middle East, the war in the Middle East, other issues all across the globe. Oil has gone up from below $70 a barrel to about $86, $87 as of today. It's a big surge in oil. This puts pressure, raises gas prices, raises heating costs. Again, this could slow the economy down. So all we're saying today is that, hey, the economy looks great. Inflation is slowing down. The markets are anticipating this. They're pricing in all this good news and great news around how the economy and inflation looks. But because valuations have surged dramatically, you have risks are increasing, and the stock market is pricing in everything being perfect. The big takeaway is that we do think stocks are going to pull back. We do think there could be a sell-off. We do think there'll be some weakness. But the good news is that any pullback, any sell-off, we think it'll be very short-lived. And let me talk about it in the last section. Why do we think any pullback, any correction will be short-lived? First of all, let's go back to correction, a stock market correction. A stock market correction sounds scary, but stock market corrections average about once per year. Remember, we had one in September, October of last year. They happen all the time because these are basically investors who've jumped into stocks and they realize stock valuations have increased and maybe taking profits. So corrections happen all the time. Why do we think any weakness will be short-lived? Well, first of all, no recession is our base case. Number two, we do think the Fed will still cut rates. Number three, corporate earnings look pretty strong. You look at this chart, a lot of bars here, but basically look at 2024. That's sort of near the middle of the page. Earnings are expected to rise 11.1% in 2024. Good news, profit margins are stabilizing. Earnings look pretty good. Even last quarter, earnings were up 4% in a very deflationary environment. It's very hard to do, and companies did this. So earnings look pretty good. And there's the old adage, earnings drive stock prices. And it makes sense. If a company generates more earnings, by generating more earnings, investors get attracted to the shares of those companies and they buy shares in the company. There's some assumptions in there, but you get the point. Earnings drive stock prices. Another reason why to be optimistic that any type of pullback will be short-lived is that there's a lot of cash on the sideline waiting to come into the market. You look at this chart. This chart shows there's about $24 trillion of money market assets and bank deposits on the sideline. $24 trillion. Not all of this will move into the market, but even like a small percent, even like 1 trillion or half a trillion, because the stock market, the US stock market is about $50 trillion today, that little movement of cash should offer some upside potential. So again, any type of correction we have, any type of market pullback will be short-lived from our perspective because of earnings, no recession, the Fed cutting rates, and just cash on the sideline. So, three themes. Number one is that the Fed goes from foe to friend. Number two is that the economy cools to a soft landing. And number three is that we'll see a big surge in volatility, maybe a pullback. If we have a pullback, it should be short-lived. What do you do? What do you do in this environment? There's two things we say. Number one, you gotta be diversified. Be diversified. And what diversification is exposure to different parts of the market. I know when we have a year like last year when everyone's talking about AI, that everyone wants just to buy, artificial intelligence stocks. Okay, that's okay. You want to have some exposure, but other parts of the market are pretty attractive too. You look at this chart, the purple bar, purple line at the top, that shows the PE ratio. Remember the valuation of large cap growth stocks like technology, like artificial intelligence. It's at 35 times earnings. It's pretty high, especially since the average is at 21. If you look at other asset classes on the bottom, all those other colored lines, they're around 15, 16, close to the long-term average. All we're saying is be diversified, have exposure to different parts of the market. And one thing about diversification, it helps to mitigate market volatility. So you look at this chart, and I know I've shown this chart to you before, but this is one of my favorites out there. What this chart shows, this shows the average, each calendar year return for the S&P 500. Those are those bars, okay? So if you look at this chart, and you can count if you want to, but basically in the last 44 years, the stock market has been positive in 36 of the last 44 years. Stock market has an upward bias. But if you look at those little red rectangles on the bottom, that's the average intra-year loss each single year. What this means is that while the stock market has an upward bias, the average intra-year loss, the pullback, the sell-off, the volatility, the correction, whatever you want to call it that year, is negative 14.2%. So long story short, stocks have an upward bias, but there's lots of volatility throughout the year. How do you mitigate against that? Again, be diversified, exposure to different parts of the market. My second suggestion or recommendation to you is you need to make sure your portfolio is diversified properly relative to your objective. You don't want to be too conservative. You don't want to be too aggressive. Instead, you want to be diversified just right. And how do you do this? Well, stay in contact with your advisor here at Wilde Wealth Management. Please be in contact. Please stay in contact because they need to make sure that your portfolio, your portfolios are aligned with your objective. They need to make sure if there's any changes in your lifestyle, any changes in anything about you, that your portfolios are properly aligned to your long-term objective. So with that said, I just want to thank you so much. If you want to follow us on Twitter, we're Cetera IM is my team and I. We're part of the Cetera organization. Or if you want to follow me, Gene Goldman, thank you so much. And please stay safe and have a good time, and talk to you soon. And I do have to show you these disclosures before I forget, so don't leave yet. There you go. Thank you.